You hear the word inflation everywhere, right? It's on the news, it's in conversations, but the real story behind why our money buys less than it used to, well, it is way more complex than you might think. So today, we're going to deconstruct what's really driving prices. We're going to look past the headlines and get into the hidden mechanics of the global economy.
I mean, it's the question we're all asking ourselves, whether you're at the grocery store or just looking at your bills. It really feels like, almost overnight, the cost of just living shot through the roof. But what if the reasons go way beyond simple supply and demand? To really get what's happening, we first need to get on the same page about what we're even talking about.
Okay, so at its most basic level, inflation is pretty simple. Your dollar, your euro, your pound, it just doesn't stretch as far as it did yesterday. It's this slow, kind of steady erosion of your money's value. But this simple definition hides a few different ways that this can actually happen.
Yeah, economists usually talk about three main flavors of inflation. First, you've got demand pull. That's basically just what it sounds like. Everybody wants to buy the same stuff, and there just isn't enough to go around, so prices go up. Then there's cost push. This is when the cost of making things gets more expensive. Think raw materials, energy, you name it. And finally, you have built-in inflation. This is that classic wage price spiral where higher prices make workers demand higher wages, which then forces businesses to raise their prices and, well, you guessed it, this cycle starts all over again.
Now for decades, economists had a pretty neat and tidy story to explain how all this worked. It was a simple model, really, built around a straightforward trade-off.
And that story has a name, the Phillips curve. The idea was actually kind of elegant. When lots of people have jobs, so low unemployment, they have more money to spend, and all that spending pushes inflation up. When unemployment is high, the opposite happens. It basically suggested that policymakers could just pick their poison, right? They could choose a point on the curve to perfectly balance inflation and unemployment. Sounds simple, huh?
Well, as it turns out, reality had other plans. In the 1970s, the global economy got slammed by something called stagflation, and that meant we had the worst of both worlds, high inflation and high unemployment at the same time. The Phillips curve completely broke, and this was a massive deal because it proved that the classic story was missing some absolutely crucial pieces of the puzzle. And that brings us to the plot twist, because it turns out there are these other, much more powerful forces at play. Drivers of inflation that you just don't hear about every day, and they don't fit into those neat classic models.
What if I told you that a huge chunk, nearly a fifth, of the recent inflation spike in the euro area wasn't really from supply chain nightmares or a crazy surge in demand? Nope. A recent study pinned a massive portion of it, 18%, on one very specific factor.
And here it is, the bombshell from that SUFERF study. That 18% came from expansionary fiscal policy. What's that? Well, think government stimulus checks, increased public spending, that kind of thing. This research really challenges the main story we've been told, showing that direct government action played a much, much bigger role in pushing up prices in Europe than a lot of people initially thought.
But government spending is only one part of this hidden story. The second unseen driver is hiding in plain sight, deep in the complex plumbing of global trade. It's the cost of just moving all the stuff we buy around the planet. Okay, so check this out. This chart from a Dallas Fed paper tells a really fascinating story. If you just look at the graph on the left, you'd think, okay, the era of trade getting cheaper and cheaper kind of stalled out around 2010. But then look at the graph on the right. The reality is so much more complicated. That solid black line shows that trade costs between the US and China have stayed pretty low. But the other lines, they show that trade between other countries is actually way more expensive. This proves there isn't one single global trade cost. It's this incredibly complex web of relationships, and each one adds its own little bit of pressure to the prices you pay.
So, we've got government spending on one side and these tangled trade costs on the other, all pushing and pulling on prices. Let's see how this actually plays out in the real world by taking a look at some recent data, starting with Europe.
This chart from the European Central Bank gives us a fantastic look right under the hood of inflation in the euro area. You can literally see it happening in waves. First, you see that massive spike in energy prices. That's the yellow chunk. But then, as that started to fade, look what took over. Services, in blue, became the main driver. This just goes to show you that inflation isn't one single thing. It's a dynamic beast, with different parts of the economy taking turns in the driver's seat.
And if we dig just a little deeper, this chart of the GDP deflator, which is just a really broad measure of prices for the entire economy, tells an amazing story.
The green bars, that's labor costs, or wages. You can see them consistently pushing inflation up. But now look at the red bars. That's corporate profits. For a while, they were also pushing prices higher, but look what's happened more recently. They've started to fall, actually helping to absorb some of that wage pressure. It's a constant tug-of-war happening inside the economy.
So, with all this complexity, all this uncertainty, how in the world do you even begin to think about investing your money? Well, sophisticated investors have a playbook for exactly this kind of tricky environment.
This really is the key question, isn't it? When you can't rely on the old, simple models, and you know there are all these hidden forces at play, you can't just bet on one thing happening. You have to build a portfolio that's resilient, one that can handle a bunch of different scenarios.
One of the core tools they use for this is something called the efficient frontier. It sounds complicated, but the idea is simple. Think of that yellow line as a basic portfolio, maybe just stocks and bonds. That line shows you the best possible return you can expect for a certain amount of risk. But what happens when you start adding other alternative assets, things like private equity or real estate? You get the blue lines, and notice how they're higher? That's the magic. It means you can get better returns without having to take on more risk. That is the power of smart diversification, especially in a world this complex.
And investors manage all this using two main strategies. On one hand, you have strategic asset allocation, or SAA. That's the long game, the bedrock of your portfolio, built on what you think will happen over 10 years or more. But because the world is constantly changing, they also use tactical asset allocation, or TAA. This is the short game. It's about making small, deliberate shifts away from that long-term plan to either protect your portfolio or maybe even take advantage of what's happening in the economy right now.
Which brings us right back to where we started. We've seen that the classic models are, incomplete. We've seen hidden forces like government spending and fragmented trade costs are huge drivers. And the real-world data shows is just this constant battle between competing pressures. So it really leaves us with one final, crucial question. In a system this complex, with so many powerful forces all pulling in different directions, can anyone truly control inflation, or is that idea just an illusion?